We're seeing phenomenal fallout across Asia, not just in equity markets, but particularly the currency markets, and of course everything is related. When do we see a Fed rate cut, if at all, this year?
So, see, I think this is a cause and effect relationship, Vonnie. And in terms of Fed rate cut, we know that the Fed has a toolkit at its disposal. And, that toolkit needs to be used only when it is necessary. Now, what the data is telling us right now, we saw very strong retail sales yesterday. We've seen three very strong prints of the CPI, and also the employment market remains very strong. Now, with this kind of a backdrop, it shows us that the economy remains very strong and there is no urgency to cut rates. So I think the rate cuts do get pushed out later in the year. Now, having said that, I do believe that the disinflation process is underway. History shows us that disinflation has never been a linear process, and we will see a few bumps. And right now what we are seeing is that, services inflation has been fairly sticky. We need to see a few more data readings before we can say with certainty when the Fed is going to cut, but I think definitely they get pushed out to later in the year.
We don't know yet, though, right? There is the possibility still that inflation reaccelerates if we continue to get geopolitical risks pushing up oil, and we continue to get currencies that are not the US dollar depreciating strongly.
I agree with you there. The geopolitical risk remains a big risk, of course, and the backdrop is not favoring, let's say, a disinflation process from that perspective. If we see any escalation in the Middle Eastern tensions, then oil immediately gets impacted, and that stokes inflation further. So yes, that clearly is a risk. And if the dollar is stronger, then the emerging markets do get impacted. And if we see rate cuts getting pushed further, then dollar remains stronger.
You haven't been making big changes to your asset allocation, even with everything that's been going on the last few weeks. Is that a dangerous strategy?
We started the year on a cautious note after having seen the bumper returns that we saw last year. From the beginning of this year, we were in a rather defensive asset allocation. And from that perspective, we did not need to change it a lot, even with the recent changes coming to fore. What we have done is that we've built a position in gold because we see it as a hedge to geopolitical risk. And also, since the beginning of the year, we had a strong positioning in aerospace and defense stocks. We were positioned in energy. We were overweight in energy. Those things continue. We think the current geopolitical backdrop further adds to those convictions. We were also overweight on semiconductor capital equipment stocks and memory stocks, which we expected to see a rebound. And that was related to the entire AI and data center demand. That demand continues from our perspective. So, yes, we do not really change our asset allocation much right now.
Is it time to reconsider just a couple of those, for example, the semis, given that we've started to see a bit of a sell-off in the megatechs in the US, and also your exposure to Japan with the yen at these levels? Is that not a little dangerous?
Yes, so I will talk about the semis first. We see it as a longer-term story, and what we see right now, if you look at the earnings calls, if you look at really the data coming out of various semiconductor industry associations, there's a very strong demand still for GPUs, for HBM, the high bandwidth memory, and that remains strong. Yes, we have these, macro data points and geopolitical undercurrents that impact the stock market, but we do not see any change in the fundamental story here. So we stick to those calls. And I think the earnings season is also going to be a big differentiator as we see the earnings coming. On Japan, so Japan exporters actually benefit when the yen depreciates. And from that perspective, if you're in a hedged position, if you're hedging your yen exposure, and yet you are exposed to Japanese stocks, the yen depreciation is good for the exporters out there, so we stick to the Japanese call as well.
And you're hedged.
Yes.
Yes. So what else should we do if we're in a little cash and there's a bit of cash to deploy? Do you wait? If markets are selling off today, could this just be a one-day thing, or is this the start of something maybe a little bit more nefarious?
So there are two forces at play here. One, we have the macroeconomic forces, where we see that US rate cuts are getting delayed, and we are also seeing that the economy is very strong. And then we have the geopolitical backdrop. To me, the geopolitics is very uncertain. The macro is not so scary because US economy being strong is not such bad news, honestly. And Fed is there to act. If the economy turns weak, then the Fed is going to cut rates. So from that perspective, we are not so worried. But yes, geopolitics is very uncertain. Any war is very difficult to call. And I think that is where we need to put in our hedges. And that's where we advocate that we have some exposure to commodities, to gold, and we can probably even buy some put options on some indices just as protective hedges within a portfolio.
Briefly, Rashmi, just because we got all of the China data just now, you are maintaining some kind of an approach to China. You're not completely ignoring it, but very measured.
Yes, that's right. So, see, from our perspective, while we've seen a rebound in the Chinese stock market, we've seen some inflows. The problem is not with the stock market, it's with the economy. The stock market is a reflection of the economy. And till that problem is addressed, the stock market is just going to, we might see a rebound, we might see a trade back, but that is not like a firm conviction trade. So yes, we are dipping our toes in China, we are being tactical, but we still do not see it as a long-term conviction trade.